Jeremy Grantham, the man who accurately forecasted the collapse of Japan in the late 80s, the 2000 dot-com bubble, and the 2008 financial crisis, is now predicting a massive stock market crash. This time, the focus is not on Japan, nor is it rooted in the past or distant future. Grantham's current projection targets the United States, and he's intriguingly pinpointed a specific time frame for when this potential crash may happen. In this video, we will give you all the details on when it may happen and why. As we always do on Profit Protection, we aim to clarify what these predictions imply for average investors in today's environment. So this is a rather fascinating theory, and let's look at what he has to say. In his recent memo, Grantham mentioned an array of factors such as the global housing market, the inverted yield curve on treasury bonds, and several others which can significantly impact the stock market. Grantham contends that stocks are currently experiencing a super bubble. He pointed out that the US stocks have gone through 4 such super bubbles over the past century, and further described this development process of the ongoing super bubble in the stock market. A super bubble unfolds in 4 stages. Stage 1 involves the formation of the bubble and a surge in stock prices to unusually high levels. In stage 2, prices undergo a significant decline, typically in reaction to a political or economic event. The third stage witnesses a bullish rally in the market, setting the stage for the final phase known as the panic or recession stage, which triggers a massive drop in the stock market. According to Grantham, investors experienced stage 2 of the super bubble in 2022, a setback. He expounded on how rising inflation was the primary driver of stock market declines in the first half of the year, leading investors to recognize that perfection will not last after all, and valuations took a step back. Grantham identifies 3 primary catalysts for the substantial drop in the stock market observed in 2022: the Ukraine war, increasing inflation, and bottlenecks in the supply chain of various goods and commodities. However, he says that none of those were the actual underlying issue. Grantham explained that it is impossible to pinpoint the specific event that triggered the 2022 stock market decline, and he says polycrisis may well be the word of the year. Grantham asserts that the ongoing decline in financial conditions will be kept off by a downturn in the housing market, marking the final stage of the stock market bubble. This could potentially drive the S&P 500 to 3,200 points by year-end in a worst-case scenario. Grantham envisions the S&P 500 plummeting as much as 50% to around 2,000 points. He emphasizes that the current situation is considerably more serious than the 2000 crash, as it includes real estate and bonds, which were not factors back then. During the recession of 2000, the economy experienced no issues with real estate or debt markdowns, but nonetheless, the Nasdaq declined by 82%, Amazon by 92%, and the S&P 500 by 50%. Grantham cautions that the current situation is not a mild setback like 2000, as it includes not only the equity market, but also the housing market and the bond market. Be advised, this is not a gentle setback like 2000. It's bad enough just doing the equity market in 2000. This time, we have done a dead ringer for the equity market. Plus, for gravy, we've done the housing market and the bond market. So what he's essentially saying is that he believes that the present scenario resembles the 2000 crash, but with deeper consequences. Grantham suggests that the current situation contains more elements that could contribute to a more significant collapse. Grantham believes that the current global housing bubble is the most important factor that may trigger a deep recession. Currently, the real estate market is slower to respond and corporate profits remain high. However, Grantham believes that the housing market is also experiencing a bubble, and it is only at the initial stage. This will likely lead to more significant economic repercussions. In 2022, we witnessed a peak in housing prices. In the US, home prices were about 6 times the average household income, surpassing the 2006 record. Moreover, the increase in housing prices worldwide is even more pronounced than the US in cities such as Paris, Shanghai, Vancouver, London, Sydney, and Taiwan. So the home price to income ratio has risen by 10 to 20 times. For instance, let's examine the home to price income ratio in Australia. In May 2022, CoreLogic analyzed the situation and found that home prices had jumped to 8.5 times the average household income in Australia. In Sydney, the ratio rose to a record-breaking 10.6. In most places, mortgage rates have been steadily declining over the past 40 years, allowing people to take on more debt relative to their income by taking advantage of low mortgage rates. The issue arises in areas with variable mortgage rates, which fluctuates with changes in interest rates. When rates increase, household incomes are strained by higher monthly payments. For example, we might see the impact of variable mortgage rates in Australia in 2023. Australian mortgages are typically fixed for 2 to 3 years and then convert to variable rates. Current rates are 2 to 3 times higher than the fixed rates in 2021 to 2022, and it is expected that nearly 80,000 fixed mortgage rates will convert to variable rates in 2023. With approximately 6 million mortgages in Australia, this could lead to a surge of over 13% in outstanding mortgages experiencing significant increases in monthly payments. Grantham believes that this increase in the housing market will have a ripple effect on equities. High mortgage rates will put more pressure on people, causing them to rely on their stock investments for income and reduce non-essential spending. Grantham argues that the housing price turmoil will impact corporate profits, which he believes will be the determining factor for the stock market's direction over the next few years. So when will the big crash begin? Well, it's quite surprising because he's very specific when it comes to timing. He said, "It's generally tough to get the market to go down between October the 1st and the end of April." So he's referring to the third year of the presidential term, which we are currently in. It's like the short seller's graveyard, then all bets are off and back to the meat grinder. Grantham believes that problems with the stock market will begin to surface after April and commence in May of 2023. This precise timing may seem peculiar or overly specific, but Grantham attributes it to a phenomenon known as the presidential cycle. According to a recent article, the presidential cycle refers to a period in the stock market that performs exceptionally well during the third year of a US president's term. It yields an average return of around 27% compared to the rest of the period, which averages a 4% return for 6 months. Currently, we are in the favorable phase of the presidential cycle, but this period ends in April. The presidential cycle is simple and straightforward, with the 7 months from October of the second year to April of the third year outperforming the remaining 41 months of the cycle since 1932. So, 2 questions arise from this observation. Why do stocks perform so well during these months in the third presidential year, and what happens after April? Grantham explains in a Bloomberg interview that the president aims for a robust labor market in the 6 months leading up to the election to make voters feel positive just before the election. However, the economy is a lagging instrument, so it requires time to heat up. That's why the president starts stimulating the economy between October and April in the second to third year, consequently boosting the stock market. After this period, Grantham suggests that we return to a grinder, meaning that there will be no more artificial stimulation and market forces will resume. He contends that these market forces will likely drive the market downwards. Now, I just want to be a bit more clear on Grantham's predictions. It's important to note that in his report, he delves into more specific details regarding the timing, likelihood of various outcomes, and the impact of inflation on these forecasts. He said, "My calculations of trendline value of the S&P 500 adjusted upwards for trendline growth and for expected inflation is about 3,200 by the end of 2023. I believe it's likely 3 to 1 to reach that trend and spend at least some time below it this year or the next. Not the end of the world, but compared to the Goldilocks pattern of the last 20 years, it's pretty brutal." He goes on to say, to spell it out, 3,200 would be a decline of just 16.7% for 2023, and with 4% inflation assumed for the year, would total to a 20% real decline for 2023, or 40% real from the beginning of 2022. A modest overrun past 3,200 would take this entire decline to say 45 to 50%, a little less bad than the usual decline of 50% or more from previous similarly extreme levels. In the worst case, if something does break and the world falls into a severe recession, the market could fall a stomach-turning 50% from here. At best, there is likely to be at least a further modest decline, which by no means balances the risks. Even the most dire case of a 50% decline from here would leave us at just under 2,000 on the S&P. So how long does Jeremy Grantham predict that this downturn will last for?
So my guess is this one will not bottom until deep into next year.
Grantham's prediction is significant, as most bear markets typically bottom out 7 to 8 months after a recession has begun. However, he argues that comparing our current market to ordinary recessions is a mistake. Instead, he believes we should be examining it alongside historical great bubbles such as those in 1929, 1973, and 2000, as well as the 2006 housing crash. These super bubbles tend to take longer to collapse than ordinary bubbles and usually experience more significant declines. Super bubbles bubbles generally take a couple of years or more to reach their lowest points, with a few exceptions. For instance, the 1929 crash took 3 years to bottom out in 1932, the 1973 crash took about 10 to 11 months, while the 2001 tech bubble took around 15 months, and the 2007 financial crisis required approximately 19 months. Grantham suggests that if we conservatively estimate 1 year from the start of the recession to the market's bottom and assume that a recession might not begin for another 6 months to a year, it becomes evident that the market's final low could extend well into 2024. However, all of this information hinges on the assumption that a recession is indeed approaching. While a recession pertains to the economy and a market crash concerns the stock market, they are distinct concepts. Although some experts argue that we are already experiencing a recession, officially we have not entered one just yet. Grantham, on the other hand, believes that a recession is practically inevitable. He said, "The most ancient and effective predictor of future recession, the 10-year minus 3-month yield spread, is now clearly signaling recession within the next year. This spread has gone negative only 8 times in the past 50 years, and all 8 times have been followed by recessions. To rub it in, there have been no other recessions." That is, Grantham's perspective on the market's direction over the next 2 years is essentially this. Once the presidential cycle concludes in April, he anticipates the market will revert to its 2022 behavior, returning to the meat grinder, as Grantham puts it. But should we place a great deal of confidence in this prediction? As independent investors, it's essential to understand that Grantham has been flagging this bubble for quite some time. In January of 2021, he argued that the next crash would be on par with those of 1929 and 2000, and in 2022, he referred to it as a bubble of monumental scale. While the market did start to stumble and decrease in 2022, his predictions haven't always been perfectly timed. This serves as a caution that his current forecast, the one examined in this video, might not transpire exactly as he suggests. That's why I personally treat every crash prediction with a degree of skepticism. Regardless of the forecast, I adhere to a steady investing approach, value investing. In fact, I actually embrace market declines as they provide something every value investor seeks: lower stock prices. If you're concerned about the stock market outlook, you don't want to miss this next video where I talk about the Ponzi-like property market in China and how a possible collapse there may affect the global economy. See you there.